Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Illan. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Hello, this is Ivan Illan, the founder and chief investment officer at Aligne Wealth Advisors Investment Management, also known as AWAIM. Thank you again for joining me this week or this month. Usually I'm doing these podcasts once a month. But this past week I finished my latest submission to Forbes, which this article is tentatively entitled, "For Decades, Fed funds remained higher than the inflation rate, maybe once again." So what this is about is that the Fed funds rate historically, if you take a look at history and actually go back over the past 50 years, 50 years, you can see that the effective federal funds rate, which is, this is the interest rate that banks earn in the overnight lending window with the Federal Reserve Bank, and this is the rate that is key and critical to the Federal Reserve in their monetary policy. This is one of their primary tools or levers that they have to actually manipulate money supply and demand for money in the marketplace. And so if you look back all the way to 1976, so nearly 50 years, essentially the average effective federal funds rate over that period of time, this critical rate that, recently everybody has witnessed, went from unbelievably almost 0% all the way to, as recently as last week, about 5.33%. And so this very, very rapid increase. Well, what is the average over the past 50 years? The average is around 4.65%. Let me repeat that. The average effective federal funds rate is 4.65 over the past half century. You can go to our website at alignwealth.com, ALIGNE wealth.com. You can actually, under For Advisors, under that tab, go to Research Highlights, and you can see this graph for yourself. And not only does it show the past nearly 50 years of the effective funds rate being around 4.65%, and today it's around 5.33%, so we're a little bit higher than average. The average 30-year mortgage rate over that same period of time, also, included in our research highlight on our website, the average for the 30-year mortgage rate is 7.67%. Right now it's sitting around 7.79%, so very close to the long-term half-century average. 7.67% is the average. The average spread between the 10-year U.S. Treasury and the 2-year U.S. Treasury. So the spread is comparing the differential between those yields, a 10-year U.S. Treasury yield and a 2-year U.S. Treasury yield. What's that difference? Well, the average is 0.88%, under 1%. So as an example, if the 2-year Treasury is at 4%, the long-term 10-year Treasury would be at 4.88%. That's just the average spread. Right now, it's sitting at a negative, 0.2. So about 20 basis points is the 10-year lower than the 2-year, because we still have an inverted yield curve, even though there has been some flattening that has been occurring, mostly due to long-term rates coming up instead of short-term rates coming down, which we anticipate that short-term rates should eventually start to come down, mostly due to a flight to quality, and that is something where you look in the marketplace for a catalyst for that, and we still believe that there can be some kind of credit event. The bankruptcy announcement of WeWork is not enough of a credit event. The market really has priced in the failure of that organization for quite some time. But I do think it's representative of the kind of, I would say, very loose decision making around capital allocation that we've seen over the past decade to 15 years. When you have ultra low interest rates, the propensity for making less prudent decisions increases, because when money's cheap, the consequences of not making as much money or having a rate of return when you're borrowing and then investing in something isn't as consequential. But when interest rates start to appear more normalized, quote unquote normalized, so if you're looking at a half century of historical perspective for the Fed funds rate at 4.65, and here we are around 5.33, this is actually a pretty normal rate to be at. By no stretch of the imagination is this abnormal. And lastly, since this is the last average I'll talk about on this particular podcast, but the past, for the past 50 years, nearly 50 years, looking all the way back to 1976, the average 10-year U.S. Treasury rate, or yield, however you want to term it, rate or yield, has been 5.87%. That's the average for the 10-year U.S. Treasury. 5.87%. Right now it's around, plus or minus 4.88%. So the average is still about 100 basis point higher than where we are today. So imagine, after all these years of getting unbelievably low returns in fixed income instruments, fixed income securities, things like corporate bonds, U.S. government bonds, agency bonds, unbelievably low interest, 0.5%, 1%, 1.5% if you were lucky over the past 15 years to be getting rates of return like that in fixed income. And, now we're looking at getting 5% on 10-year U.S. Treasuries, risk-free rates of return. Corporate bonds paying closer to 6%, high-grade corporates. Junk bonds right now paying in the 9% range. However, a footnote to junk bonds currently, or high-yield bonds, the spreads over the risk-free rate are still quite compressed. So the market is not perceiving a tremendous amount of risk in the marketplace. It's almost laughable that the market is so really not concerned at all about any kind of credit event or defaults or bankruptcies of any major brand names. And yet there is this massive amount of debt that's going to be rolled over, refinanced. It's beginning this year, it's continuing into next year and the year after next. And the idea of having much lower interest rates or even lower interest rates at all, certainly something coming from the Federal Reserve in terms of reducing rates when your long-term effective federal funds rate is around 4.65%, and your long-term 10-year Treasury is around 5.87%, that's more of a historical perspective. And so, what this Forbes article also continues to go on to say is that for 2 decades, you were looking at a effective federal funds rate which was higher than the rate of inflation for 2 decades, more than 2 decades, 22 years to be precise. And so you could actually say that that's more normal. It's actually more normal to see the Fed funds rate be higher than the inflation rate because it's a primary technique to tamp down on inflation. And especially after trillions and trillions of dollars are being injected into the economy, you really have to keep rates higher for much longer. And I think most of the market is not anticipating that at this point. They're certainly not pricing that into, you don't see that priced into spreads at all on fixed income instruments or high yield instruments. The equity risk premium looks like a very poor and very low premium that you receive by investing in equities relative to a risk-free rate. And that's not good for equity valuations. It's not good for equity pricing. And I think because of this recency bias that market participants, investors have had over the past decade plus, they've really been lulled into this expectation that the Federal Reserve Central Bank is going to continue to be very accommodative to the economy and to the participants by keeping interest rates extremely low forever. But that is a complete nonsensical conclusion based on history, but also based on proper macroeconomic theory and money theory and supply and demand of money and money supply. So this is absolutely one of those times where being very familiar with the fractional banking system, being familiar with U.S. Treasury financing and debt issuance, being familiar with the Federal Reserve Bank and their goals and their tools that they use to enforce and make progress towards those goals. You really have to be familiar with all of these things, and this is certainly something that we obsess over, I would say, probably an inordinate amount of time at our firm. And of course, we're happy to have these conversations with you in the marketplace, financial advisors, RIAs, retail clients, high net worth clients. We're available for this conversation as you see fit to review and analyze what's going on and the kinds of risk exposures you may have in your portfolios. Be on the lookout for the Forbes article. It should be published later in the month. And you can always go to Forbes.com and type in my name, Ivan Illan, and you'll see the archive there for all of my published Forbes articles, historically going back to 2016. And look forward to next month sharing another perspective. Take care.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanillan.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.